all CEOs, me included, we don't actually know what we're doing.
They're all sharks, so all you got to do, though, is know shark behavior.
I don't think we've ever talked about this before.
We can capture all of the wallet share.
First place you start is with the product.
That's just the first note.
This is the Capital Stack.
Hey everybody, this is David Paul, the host of the Capital Stack podcast, where I talk to founders, investors, and operators about all things value creation in startups. Today, I am speaking with Hamid Shojaee, who is the founder and CEO of many startups, including Axosoft, sold it, GetKraken, sold it, PureChat, sold it, Nettime Solutions co-founder, sold it, and now at Savvy Trader, which is his new startup that he's working on. He's also a very big contributor and author, starting to become very active on FinTwit. It's a masochistic behavior. I can't believe you're actually doing that. And an investor, both in private and public. So with that, I give you Hamid Shojaee. Hamid, how are you doing?
I'm good. How are you doing, Dave?
I lost my wallet today.
Did you really?
Yeah, and it's like this thing in the back of my head. So I don't know if I left it at home or like it fell out of my pocket. And it's just one of those things. Like, it's not that hard to cancel your credit cards and get another driver's license. But it is like it's bothering me. I can't get it out of my head.
Yeah, I mean, plus it's like these annoying tasks that you have to get done now.
Yeah.
Right. All of a sudden, like, your task list just got filled with a bunch of different things that you didn't plan on.
Exactly.
Yeah.
Exactly. I have enough problems. I don't know. I don't need that. I got kids and stuff. So I mean, tell me a little bit about your background, and how you kind of went through your entrepreneurial journey and how you ended up at Savvy Trader.
Yeah. Okay. I'll do the 30-second version. I was born in Iran. My parents immigrated to the U.S. when I was 10. They were entrepreneurs, so I was around entrepreneurs all the time. They had like a gift shop in Old Town Scottsdale. My dad bought and sold cars. So, sort of grew up with entrepreneurial mentality and fell in love with software in my teens and always knew I wanted to do something in software, start a software company. Kept bothering my roommate in college to start something in software. We finally did. That was the Nettime Solutions you mentioned. I was not part of it when it was sold, but I gave it a good effort for like 5 years and gave up and left. And the company went through all kinds of struggles. But credit to my partner there. He stuck through it. They sort of rebuilt it and from the ground up, and ended up selling it many years after I had left. And then I started another software company after I had left Nettime Solutions a few years after. That was Axosoft. Built that for 18 years. We had a side project that sort of took off. That became PureChat, which was a side project that we spun off into its own company. So coincidentally, Axosoft and PureChat were both sold in 2020. Axosoft had two products. We had a project management product, which was called Axosoft, and another product called GetKraken, which was still part of the Axosoft entity. So when we sold Axosoft, GetKraken was essentially part of that.
But it could have been its own business, right, from a product perspective?
Yeah, in fact, that was the main reason the acquirer wanted to buy it is because of the GetKraken product. And the company now is renamed to GetKraken. So.
Like one product sunsetted, the other one rose.
That's exactly right.
Yeah.
That's exactly right. And then I retired for a little while. That was about 1.5 years, and got bored and started another software company called Savvy Trader. So here we are.
And tell us about Savvy Trader.
So Savvy Trader is this idea of being able to recreate and share your investment portfolio in the stock market with other people, right? So if you invest in stocks, oftentimes people are talking about what they're buying or selling with their friends or family, but there's no easy way to sort of like notify people of what you have, or like let people see exactly what you have and when you're buying or selling them. And Savvy Trader sort of makes that super, super easy. And it's the intent, like the initial idea was because I often shared my investments with friends and family, but I had no sort of systematic way of like, if I talk to them about a particular stock or investment at dinner, I might not see them again for 3 months, and who knows what I was doing during those 3 months.
Right, and then you could have sold it, and they're still in it.
Right, or sometimes the stock moves one direction or the other, and like I might buy some more if it goes down, and people often panic and sell when things go down or whatever. But so the idea behind it was to sort of share that knowledge and be able to sort of show transparently what you're investing in and how was your performance over time. So if the person that you're that is talking a particular stock even knows what they're doing,
right?
So showing that performance is a pretty big deal. And quickly we realized that, okay, well, there's a lot of people in the social media universe that are talking various investments, and they're all the Michael Jordan of investing, right? But you can never see their performance.
There's a gazillion experts.
That's right. And so Savvy Trader makes it super transparent for people's past performance, right? From the moment you start using Savvy Trader, we track your performance, and then like over time, we can show that performance to others. So either you're full of shit and you don't know what you're doing, or your performance sort of reveals itself over time, and people can, your subscribers or followers can sort of value that judgment.
You should do that for angel and venture. Everyone lies about those portfolios too.
Yeah, but at least the investors in venture or angel investments, they know how their investment has done. But like when you're seeing someone on Twitter talk about how well they have done, you don't actually know whether or not they're being truthful.
Yeah, when'd you get in, when'd you get out,
right? And everybody, supposedly has had perfect timing on all that stuff.
Exactly. So that's interesting that you mentioned timing. So why did you call it, and this might have just been a nuance, but why didn't you call it Savvy Investor versus Savvy Trader? And do you see like a difference between trading and investing in your customer profile?
So it's probably a little bit of my own naiveness because I'm a long-term investor in the stock market. So when we were deciding on names, Trader was sort of like the easier one that we found, and Savvy Trader just made sense. You are sort of, when you're investing in the stock market, you are doing trades. So I thought it made a lot of sense. It turns out that we later found out that like people who call themselves traders are usually day traders,
right?
Versus long-term investors don't call themselves traders. I mean, like really the tool can be used by both, so it's not necessarily a bad thing. Day traders can go prove out their performance on Savvy Trader as well. But generally speaking, like I'm personally a long-term trader. A lot of people on the platform are long-term investors. Savvy Investor may have been a better name, but I don't even think that was available.
How do you differentiate between a trader and an investor? Like, do you think it's a hold of a year or more? Or?
No, not necessarily. I don't have any preconceived notions of how long I should hold on to a particular investment. But, a lot of day traders will sort of like invest based on what they call technical analysis, which is usually watching a particular pattern or moving averages of a particular stock, whether it's going up or 50-day moving average has hit a particular peak or valley or whatever, and they sort of do trades based on that. To me, that's very disconnected from the reality of how is the company doing, and is the company overvalued or undervalued, right? So my investment style happens to be where I evaluate the company and I determine whether or not I would buy the company at the current market cap price if I could buy the entire thing, right? So, when I was investing heavily in Meta, for example, I wasn't looking at Meta's price per share and how its price per share was moving. I was looking at Meta and thinking, is a company that generates over $120 billion in revenue, over $40 billion in profit, worth only $200 billion? No, that's a fucking steal. I'd take that all day long. And I just went heavily into it, right? But is it worth $1 trillion? Maybe not, right? Like, so that's, in my opinion, that's the right sort of way to invest. And then you sort of wait it out, right? Like the market is temperamental and it goes up and down for a variety of reasons. And you just got to kind of have a Zen-like attitude about that.
So what happens if you want to get into investing and it's like, there aren't really any good deals? And like, how do you think about dollar
cash?
But I mean, like, are you a fan of always be invested, dollar cost averaging?
No,
kind of coming in because you can't really time good value versus bad. Looking at trends. I mean, everyone was saying, Facebook's going to get demolished by, TikTok, and that didn't happen, right? But no one could have called that, right?
I mean, I did.
Yeah, of course you did.
but like I think that like the dollar cost averaging is a good strategy, especially like if you are new to investing. It might make sense not to put it all in at the same time, but also having some cash on the sidelines. Like even right now, I think my portfolio shows I'm 26% in cash, something to that effect. And, cash is always good to have around, especially when the market presents like insane opportunities, right? And in 2021, as an example, I thought the market was so overvalued that I think it was like 60, 70% in cash. In 2022, like last year when I first started, like most of the 2022, my portfolio was showing like 40% or more was in cash until like it just became kind of ridiculous, and like Facebook was being valued at a ridiculous price. And same with Robinhood, by the way. I thought Robinhood, like at one point, was being traded at below its cash levels, which is kind of insane. If you're an investor, you kind of, especially in the startup world, that like the amount of cash you generally invest in a company, you're getting at most a quarter or maybe 1/3 of that company. So the fact that Robinhood had as much cash as the entire company was worth at one point in time based on its stock price meant it was just valued ridiculously low. Mm-hmm. So I went heavily into those stocks, largely because the opportunity presented itself. You got to be patient as an investor. And the other part of it as an investor, you also have to be patient in waiting it out, right? Like, so Robinhood has not gone up significantly since I've invested in it, right? But I'm patient. I'm actually adding to my Robinhood position as the price continues to sort of fluctuate and go down on the valleys. I end up sort of like adding some more. Something like 20% of my portfolio now is in Robinhood.
Okay. And so value, right, is definitely the leading indicator. But like, where does news is, it's not an indicator, but it is a data point.
Oh, for sure.
Right. Yeah. And so like what made Robinhood go down? Are they burning cash? I don't know much about the stock.
They were, quite a bit of last year. And the whole sort of meme frenzy with GameStop sort of burned them quite a bit because they sort of made some mistakes there. There was a lot of people who sort of swore they were like in cahoots with Robinhood was intended to sort of equalize the playing field for investors, right? For the little guys. And a lot of people accused them of being in, with the big guys when the whole sort of GameStop fiasco happened and they stopped the trading of GameStop. But, if you looked into the details, you kind of came to the conclusion that Robinhood had no choice and they were sort of like put into a situation that it was either like kill the company or not allow GameStop to be traded for a day or two, or whatever happened. I mean, that, may have been a mistake in retrospect, but they also didn't die.
Right.
So,
I mean, there is switching costs. I mean, it's a pain in the ass for somebody to switch, right? Are they really going to get rid of all their trading because ... right?
So the news was very negative around them, but like oftentimes when the news is negative is also the best buying opportunities. Like last year the news was so negative on Meta that like, oh, Meta's going to die. Like a lot of people thought I was so crazy for buying Meta because Meta is about to like basically
it's like the evil empire, right? Yeah,
but not just the evil empire. A lot of people don't care whether or not it's an evil empire if it's making them money, which is kind of another sort of interesting idea that like, I don't care if it's ExxonMobil, as long as it's generating money for me. But that's the evil empire in my view. But Meta was being sort of like predicted as a company that was going to go bankrupt for a lot of people. But Robinhood was another one. Tesla was another one. Twitter was another one. I mean, like a lot of these companies are pronounced dead oftentimes. And, those present the best opportunities if the market is wrong about them.
Do you think that that's like short selling, intentional behavior? Or
Oh, for sure, some
Yeah.
of it is, right? But I mean, others, it's just, like people's opinions, legitimate opinions. But short sellers add to the fuel, the fire. They add fuel to the fire for sure.
How do you identify going in and out, right, of specific positions, tax consequences, right?
Yeah.
And versus, I mean, Facebook's high, you can sell it. Let's assume that, you're you're completely, out of the woods, right, from your cost basis. So you're paying, capital gains of X%.
Right.
Which it's cheaper than any other kind of income you're going to pay, but,
Yeah.
It's, upwards of 20%, right? Or 15 to 20%.
Roughly 25 with
Depending.
state tax too.
Right.
But,
Yeah. And so, I mean, you're literally taking a 25% haircut to put money on the side, and
Right.
you're kind of waiting, right? So it's like, why not wait until, still look for the great opportunities, but just sell out when that happens, right? Because your tax liability actually might not be as high,
Yeah.
right? Do you think about that at all?
Oh, for sure.
Yeah.
And in fact, every dollar you keep in, if that stock continues to do well, the portion that you would have paid on taxes is also growing.
Mm-hmm.
So you end up doing better. So over a 10-year period, if you could buy one stock and hold it for 10 years, and that stock, just for sake of argument, continued to go up 20% year over year. But another strategy was that you sold a stock or many stocks every year for 10 years throughout the 10 years, and you still average 20% year over year. The one that you bought and hold for 10 years would actually have significantly higher value at the end of the 10-year period, largely because of the tax consequence. So let's say you sold it at the end of 10 years. After paying taxes, you still have more money in that one than the other portfolio where you're buying and selling stuff every year.
Mm-hmm.
And that's because of the additional gain that you would have on the taxes you didn't pay throughout the 10 years, right? So yeah, I definitely think about that. And I try not to sell too early if I can. If something gets completely out of whack and way ahead of its stock price, I do sell just because I'm like, okay, at this point in time, it might not make sense for me to hold on to it anymore, or at least a portion of it.
Yeah. I felt that way about NVIDIA, 2 years ago, and I was wrong. I was like, oh my God, I made so much money off this. I think, we're good,
Right.
and then what's it up, 250% this year or something?
Yeah, the whole AI craze, you couldn't have possibly seen it 2 years ago.
No.
But I'm one of those people who thinks NVIDIA is way overvalued right now, right?
Yeah.
So,
I don't think look at ARM. I mean, they were 5 times oversubscribed, and that's not a great company on their IPO.
I mean, all you have to do is look at Intel.
Right.
To see where
Where's this going? Right.
Yeah. And Intel still has more revenue than NVIDIA, but it's trading at roughly, 1/7 the price of NVIDIA.
Well, but then how would you look at Tesla, right? Because I know you're, we're a big, you made some, you did really well, on that. So everyone's like, oh, it's a fraction. There's only so many cars on the road. It's a car company. How did you kind of oversee buying into that concept? Was your entry point at a good valuation, or did you see the growth?
I think my entry point on average was around $12 a share, something like that, 12 or maybe plus or minus a couple of dollars. But with Tesla, I was buying between 2015 and 2019. 2019 was when I went all in, when the market had just decided that Tesla was going bankrupt. That was another example of company that was basically pronounced dead by short sellers, by a lot of the sort of news sites, everything. In 2019, I think it was May, June timeframe of 2019, Tesla's entire market cap was roughly $35 billion. So you could buy this company that had $25 billion in revenue in 2019 or the previous year for $35 billion. And it was on a trajectory that every year it was just killing it. I mean, it was just going up 50, 60% year over year, 70% year over year in revenue. And there didn't seem to be any sort of stop because they hadn't even penetrated 1% of the car market yet.
Correct.
And that was just the car business. And it was clear as a Tesla driver that their vehicles were fantastic. They weren't catching fires, just, all the rumors were bullshit, basically. So,
but the unit economics weren't that great, were they?
They
on
weren't
Tesla.
bad.
I didn't know the story. So they were burning cash. Obviously, there was government subsidy, I think, attached to it. So did you weigh that in?
Yeah. They were always profitable on a per vehicle basis.
Got it.
But like they had to hit a certain number before they were like profitable on their own, and it was clear it was going to get there. And but the price of the company and the way it was being hurt was based on vehicles not being news articles and like rumors that the vehicles were catching fire. They were not good. They were just poor quality. Nobody wants an EV. Those were sort of like the stories in 2019, and one of the advantages that you have as a potential investor is investing in things that you know or products that you use, right? Mm-hmm. So, like, I often use this example. I haven't personally invested, and I should have. But if you happen to be a yoga person and you sort of like started wearing Lululemon outfits to yoga classes and realize that this company is public and it's just the beginning of the like craze for the yoga people to start changing out their outfits to Lululemon. If you would have just invested in that company until you hated the product, you would have done incredibly well, right? Like
I caught that one.
Did you?
Yeah, I did.
You were in Lulu?
I was in Lulu early, and I literally just went to Viore because their product went to shit.
Yeah. Okay. So that's perfect. So like now it might be a good time to get out of Lulu. Right?
Yeah.
Because now they've done their growth. Okay. So how much more are you? Like the possibility of growth has diminished pretty significantly, right? So, I mean, they still might, but like it's different than early days.
I think when they started doing the mirror stuff, I was like, okay, this is this is going in a different direction.
Right. But, me having been a Tesla user, I kind of knew early on that, like, okay, this is a really solid company. Product is pretty amazing. The future is this. And, I felt pretty confident in that investment. Same thing with Twitter. Like Twitter went down before Jack Dorsey, it was pronounced dead. Or after Jack Dorsey came back, it was pronounced dead. Twitter shares went all the way down to like $12 or $13 a share. And, that was like, I use Twitter every day. Like I've been looking at their financials. It doesn't look like, and they have a ton of cash. This company is not going anywhere, So cash on hand is another sort of great indicator as to whether or not a company is solid enough to sort of go through their troubles or turmoils or not, right?
So now you're a pretty active member of FinTwit.
Yeah.
So, I mean, like you might have been more before, but I'd notice it more now because of Savvy Trader. I mean, doesn't that just beat you down emotionally?
No, I love engaging online, like with people. I mean, people are very, like, because it's not face to face, right? So people are very blunt and they're like
people
call you
tough.
stupid or like, or act tough, whatever. But like, I enjoy it. I try to sort of not attack people personally, but like I respond with the reasons why I believe something is true.
Mm-hmm. What about diversification, rebalancing?
Yeah. So
you have pretty big positions, right?
Yeah.
Actually, let me ask this question before that. Your portfolio in Savvy Trader, that's not your entire portfolio. You have real estate. You have private equity funds. So
I used to, but I recently went through a divorce. But like I don't have a lot of real estate actually. I have a building that we're selling, but no, that portfolio represents probably more than 90, maybe 80% of my net worth now post divorce.
yeah.
Right.
This will not be used in testimony.
but I think, and it's like everything. It represents my IRA, I have multiple brokerage accounts, and the one portfolio represents all of them. So going back to diversification, though, like one of the things that you sort of grow up learning and getting engraved into your head is don't put all your eggs in one basket. But it turns out that's not really great advice, right? Like Warren Buffett has a great quote that sort of summarizes how you should be thinking about it, which is that focus or like very few investments is a great way to build wealth, and diversification is a great way to sort of maintain wealth, right? So I would challenge anybody to find a billionaire or extreme millionaire
Who didn't bet big
on a single thing, by the way.
Right.
Right. Like usually most of them are entrepreneurs who bet big on one thing, their own company, right? Or themselves, which is the best bet you can make, by the way. But even on investment side, if you're, let's say you're, just for sake of argument, you're making, and this is not investment advice, but so let me put that out there. But let's say you're making $100,000 a year and you're investing 10,000 of that per year. Okay. And you put it into S&P 500. This is the sort of like the common advice that people get is just put it in the S&P 500. You're sort of like diversified. It's really good. The stock market generally goes up. Yeah, that's probably good if you want to spend zero time thinking about things and making your own decisions. And you'll get like 8% on average. That's how well the S&P has done over the past 20 years or whatever. But the S&P is an index of 500 different stocks. It's extremely diversified. So it's a great way to conserve wealth. But when you're investing $10,000 a year, that's not wealth, right? Like, so if you're hoping that that $10,000 a year is going to make you a millionaire after 15, 20 years or whatever, when you put in a couple of 100,000 into it, you have to be way higher risk, right? And, like if instead you took that 10,000 and invested it in, let's say 3 stocks, but companies that you used the product of and you felt confident about, and those companies were relatively young, which is hard to find, by the way. It's hard to find products that you use who happen to also be public, who happen to also be young, right?
Yeah.
Because like we all
especially
use Apple.
in tech.
Right. Because we all use Apple, but like now Apple is a $3 trillion company. I mean, it's already done its like major moves. Apple is probably never going to 10x again in my lifetime. Or maybe not my lifetime, but at least the next 10 years it's not going to 10x, right? Whereas in the previous 10 years it has. And previous 20 years, it has more than 100x, right? So that's the kind of stuff you want to be able to find. Yeah, I mean, like, I think they're out there. They don't come around all the time, but they do come around quite a bit. If you were a Netflix user and you're like, man, this is great. Someday everybody's going to be streaming. 10, 15 years ago, if you made that decision, you would have done well. If you were an iPhone user and anytime by 2011, 2012, you would have invested in Apple because you're like, someday all of these, people are going to have iPhones. You would have done well, So I think it's not super difficult to find great companies to invest in, and picking a very few number and making bigger bets is a better strategy. It has been a much better strategy for me. I have actually averaged over 30% return year over year for the past 20 years, which is unheard of. No one believes me when I say that, by the way, because that's a 200x return over 20 years. And I mean, like for every dollar that I kept in that I put in 20 years ago, that dollar is over $200 today, right? So no one believes it, which is part of the reason that I also motivated me to build Savvy Trader, because now I want to prove it. Right? For the next,
I am so insecure about this. I need people to know about it.
Well, it's not an insecurity. It's kind of like I have no way to sort of easily prove it, right? But like, and I don't want to put out like details of my financials out there from different years. People wouldn't believe it anyway. You could screenshot, you could Photoshop all that stuff. So now my portfolio is public. People can follow it. They can see for themselves, and it's been public for over a year and a half now.
And so I get it, right? That you've done really good at picking, right? You've done some great picking. What about the person? It's just like the active inactive, right? And we just kind of all talked about that. Usually active pickers, let's just say someone's just completely ignorant, right, to the stock market, and they pay a picker, right? Would they be better off paying a picker, or would they be better off just being in an index?
Well, yeah, that's a great question. I mean, the general advice to them has been put your money in an index. And actually, the general advice for them by the pickers, the sort of like the industry experts, that if you go to a financial advisor, they'll charge you 1% of your money per year.
Right.
So, if you're investing $100,000, they'll charge you $1,000 a year or whatever to put your money in an index, which is kind of like how stupid is that?
What am I paying you for?
Yeah, exactly. And that's the sort of like overwhelming advice right now on the market. And again, like Savvy Trader, and I'm not here to sort of like promote Savvy Trader, but like the idea behind Savvy Trader was also like to sort of
get ideas.
allow people who might not know to see other people who might know a little bit about what they're doing. And you can tell that based on their past performance, because we show you their performance over time. You can see their sort of thought process as to why they're buying something, why they're selling something. They can make comments about the market, and you can see what they hold. So if you wanted to, you could replicate their portfolio. That's totally up to you, but
right.
Yeah.
What about, how do you think about biases when investing? Right? Because there's a lot of them.
Yeah.
And I've been reading some books about biases and learning how to make decisions, and specifically book by Annie Duke right now. I think it's called How to Make Decisions or something. And she's a poker player, right? And, everyone makes decisions on a limited basis of information. And generally, people make decisions based on the outcomes that those decisions made, not by the decision-making process. But there's a step in between there, which is called luck, right? That accounts for a lot. You could have made a great decision based on the information you had, but it didn't turn out good, and vice versa, right? You could have made no mental model or work to make a decision, and it turned out good, and you might think that would be a bias that you would have in the future. So how do you think about biases?
I mean, I probably don't think specifically about biases in particular. Everyone makes mistakes, and usually if you like sort of trace it back, your mistakes are generally have something to do with your biases, right? Like,
sure.
I have a bias towards, for example, excuse me, a great future, like that is driven by green energy and, companies that might be doing good for the environment. So I've made it, like one big mistake in that area as well. So like one of the companies that I started investing in is a company called Arcimoto. And Arcimoto makes this sort of 3-wheeled electric vehicle that's kind of like a cross between...
I was in a ride. You rode around in that with you.
Did I give you a ride?
Yeah, you gave me a ride. It scared the shit out of me. But yeah.
Yeah. I actually started investing in pretty heavily in it before I bought the product. So I wasn't a customer. I didn't know as much about the product until after I bought the product. When I bought the product, something interesting started happening, which is people were like very intrigued by it. It's a good product, but it had this sort of like 3-wheel, like a lot of people's sort of perception was like, that's like not as cool as a motorcycle. It didn't have the cool factor, right? Like,
is this a bike? Is this, or is this a car? Like, how am I supposed to think about this?
Right. So one of the things that I didn't realize, actually, like my son, who was excited to see it. We took a ride together. And then I was like, do you want to drive it to the Scottsdale Quarter, which is where we were going? He's like, no, I don't want to be seen in that thing at the Scottsdale. And I was like, what? So like it literally, that's when it sort of dawned on me.
That's so funny, dude.
And like I changed my position on that, but it was like by then the stock had already gone down like something like 60, 70%.
And yours was yellow too, right?
Yeah.
So like he really didn't want to be.
Yeah. it grabbed people's attention, but that's a good reason to like be a customer of a product, right? Like before you go all in, and I had gone all in before I was a customer of the company or product, and I slowly realized that not only was the product not going to be super desirable in the marketplace, but also the company had other sort of execution problems that even if they solved, they weren't going to get there. So yeah, I mean, like I lost a pretty substantial amount of money in that particular investment. But here's the cool thing about investing. Is that you can lose, let's say 100% of your money in an investment or multiple, but another investment can go up 400%, right? There's no limit as to how much they can go up. There's a limit as to how much they can go down, unless you're doing risky stuff, which I don't advise. But then the ones that go up can very well make up for the ones that go down.
Yeah. And there's like that emotional response, right? That people are much more affected by losing money than they are at making money.
Right.
Yeah, and I have that bias. I hate losing money.
Yeah.
I'm in the wrong profession, honestly. But and when I do make money, I'm like, I didn't make enough.
That's probably a bias everyone has to some degree.
I'm just perpetually unhappy. But that's just a personality problem.
I mean, it might be a human problem.
Yeah. So what are you excited about the next couple of years? What's going on with Savvy Trader? What are you doing in the next couple of years? What are some big things?
Well, we've made Savvy Trader into like a generic investment tool besides being something that you can share portfolios and discover other people's portfolios with. Like earnings season is coming up. The best place to see who's reporting earnings and what the analyst expectations are is on Savvy Trader.
That's hard to find.
Yeah, it's
right?
extremely hard to find.
And Yahoo Finance is unusable.
Oh, yeah. I mean, like I was an avid Yahoo Finance user before Savvy Trader, and one of my goals was to like never have to go to Yahoo Finance, and I never go to Yahoo Finance anymore. Savvy Trader is my tool for news, for seeing who's reporting, for getting stock quotes of things I didn't even own, right? Like, let's say Rivian is going down 20% one day, yesterday. You want to know what the hell's going on. Where do you go? I mean, like now I go to savvytrader.com, right? Like it's got the news there as well. I feel like this thing is becoming a Savvy Trader ad, and like, that was not the intent.
Yeah, well, I mean, you're paying me for this, so I mean,
no, I'm not. That's not true.
Well, no, because I think I want to talk about what people think are excited about, right? And
well, let's move off of Savvy Trader. Let's talk about what are we excited about, like in the world that's happening in the world.
Okay,
Starship is an exciting thing that's happening, right?
Yes.
Are you excited about that?
I'm excited about Starship. Yeah, I'm excited. I'm excited. Honestly, I mean, you say what you want. I mean, I like everything that Elon's doing.
Yeah, me too. I mean, like he's
an asshole.
Yeah,
but,
he's a yeah. I mean, I don't disagree. He's a good asshole, right?
Totally.
Like he's a good human being who's trying to do amazing stuff, and he happens to be an asshole who says some crazy ass things as well. But like Starship represents the best opportunity, possibly the only opportunity. Like certainly it wouldn't have been happening without Elon. That someone like you or myself might have to go to space, possibly the moon in our lifetime. Right, so that might actually happen. I mean, like if Starship happens, cost on a per person to go to space is going to drastically reduce, possibly by two orders of magnitude, meaning like 100 times. So if you could, take a trip to the moon, and take a 10-day trip, stay at a hotel. I mean, like those things are things that are going to be possible because of Starship. Possibly in as early as 10 years from now, right?
It's incredible. It's incredible that he completely dismantled like a completely entrenched, market of, advanced aerospace companies and was able to create, incredible value. Not to mention, I mean, listen, I funded 2 sets of founders that, were spinoffs of, one was Tesla, one was SpaceX. And they said the same thing. It's like, it was the most intense place I've ever worked, and like you lose, it's like dog years. You lose 7 years after every year, but you get out of there and you're just kind of like, if you work for another company, you don't start your own company, you're kind of like, what am I doing here? Yeah. Like there's no, there's no intention. Right. But yeah, I mean, I think that, being able to go into space, I think that industry has had some big contraction, because of obviously venture funding and stuff. But if you look at aerospace, you look at defense, you look at, how the supply chain is set up for that, it's completely broken. It was like set up for like, America in the 40s and 50s, which is like, we need more jobs. And there's like this giant fragmented pyramid of different tiers of supply chain used to make these rockets or missile systems or whatever, and it's just completely and utterly broken. There's no one to do it. There's actually some really interesting companies out there that are breaking that right now, which is interesting.
Yeah. I mean, and the sort of, the goal of what Starship is trying to do, and just like the goals that Elon sets in general are so crazy different than like what normally NASA would be trying to do, that just partial success could be like 10x better than anything NASA could have hoped for. You know what I mean? And certainly the way that the previous companies, Boeing and Lockheed and the ULA, as they call them, the United Launch Alliance, were operating was not going to be something that was ever going to get us even to the moon again. Let alone.
They're calling it in, man. Fat cats don't eat. They don't hunt.
That's right.
You know what I mean? They were just, they were just order taking.
Exactly.
Who's going to break healthcare?
I think it might have to first break us before, meaning like the U.S. budget before we sort of like pay attention to it. Like we as a country, we only sort of fix things that are completely broken, not partially broken. So it has to completely break before we're like, oh, okay, wow, this doesn't work. But it's totally unsustainable. Healthcare like costs are like ridiculous. I mean, we spend more than any other country. We get worse results than most other countries. I mean, like it's so messed up. I mean, nobody knows even where to start. There's so much requirements. I mean, it just you almost have to wipe the slate clean. Yeah, and that can't happen with all of the sort of systems and players involved.
Yeah, no, it's I would like to see some kind of wedge, because I think everything just has to, like, this little virus needs to kind of go in there to create, something bigger. Right. And
you're right that might, something might come across. Like for example, a really good example of a wedge that sort of helped transportation, for example, was like taxi system was completely broken, and Uber came along and like sort of broke all the laws. Right. And like got away with it. Why? Because the people wanted it, right? Like, and correct. And like everybody who tried to ban Uber, people revolted, and those states or countries had to sort of relent and be like, okay, you don't have to get taxi medallions to operate or whatever, right? Like, whereas prior to that, to operate a taxi, you had to pay $250,000 or, but like I think in New York, you had to pay $1 million to have a taxi driver or a taxi medallion, right? So it had become this ridiculous system that was impossible to penetrate. But then like Uber came along and did it somehow.
There needed to be a technology that, enabled it, right? Which was mobile.
Well, not just that, but there had to be a willingness to break the law. I mean, like, there's no other way to put it, but they freaking broke the law everywhere.
They did not care.
They did not care. And what they counted on is that they will become more successful and people will love them more than the speed at which the regulators and lawmakers can respond and shut them down. And by the time that happened, they were so big and the people wanted them so much that they essentially won, right?
What's another example of that? Airbnb hotels?
Oh, Airbnb is probably another great example. But they didn't like completely disrupt the hotels. Hotel businesses continue to do really well.
Yeah. And they carved a nice little pocket out of that business, though.
Yeah. I mean, as a business, they've done well. But like, I don't know if... like to do that in healthcare, I think it'll be interesting to see how healthcare gets fixed, but it's not going to be in a traditional way.
It's almost just got to be completely like, I think maybe it's a fee for service model, but there's no Medicare reimbursement. There's no, like, literally people are saying, okay, this is what it costs for me to check your throat. This is what it costs to have the broken bone. And like, literally people are just transacting.
Maybe AI is what fixes healthcare. I don't know. Like, because if, AI could diagnose you, tell you exactly what's wrong and like also write prescriptions, then it costs near nothing.
Yeah. That would be nice.
AI, right?
Yeah. I think they're just going to deal with, it's just a human business, right? And I don't know if people are going to trust that.
Well, I mean, if they might not have choice, right? You go to the doctor, pay $500, or the AI can take care of you for $5.
Right? Like, right. You're going to pay for it out of yourself, or well, I think like what we're going to see is, this is not AI or technology, but like if you have any type of illness, you're never going to see a doctor. You're going to see a nurse practitioner, and there's just going to be, and there's like the doctor's just going to be quarterbacking his license,
right?
because, and then, what's happening now is it's like, it's just all this like consolidation, with the CVS is now going to try to send all their insurance people. Like I was at Walgreens and I just changed my insurance to Aetna, and they're like, "Oh, we don't take your insurance." I'm like, what are you talking about? There's two of you, right? You don't take my insurance. They're like, "Oh, well, Aetna, you have to go to CVS now." And I'm like, that's kind of crazy. You're forcing me to go to CVS. You're an insurance company.
Backwards. I went to CVS. They're like, "We don't take your insurance." You gotta go to Walgreens. Just like, are you kidding me?
Yeah, so it's like you're just kind of consolidating my choices. Right. It's kind of unreal.
It's pretty stupid.
Yeah.
Healthcare is broken in a lot, and prescription drugs are also like very, very broken. But yeah. What are you reading right now? I'm reading the Elon Musk book, which is fascinating.
Yeah.
That's actually pretty much it, because I don't read a lot of books. I don't have the time for it.
Totally. I hear you. I like doing the audio if I'm like working out or something. That's usually a good. It's like drinking your vegetables, It's a little bit easier to do.
But with all the podcasts I listen to Lex Friedman and, like your podcast.
You don't listen to my podcast. Don't lie. If you listen to my podcast, you'd be complaining to me. I know. So I know you're not listening to my podcast.
Really?
Yeah.
Damn. But
my podcast is so shitty that you would actually be complaining to me about it.
But no, in all seriousness though, there's also too much to listen to as well. That books are like so last year's stuff. It's just outdated.
Yeah, no, I think that's an interesting thing. It is kind of like a nuevo like kind of book, right?
Yeah. The Elon Musk book in particular is super fascinating because it's very up to date. It goes like literally up to I don't know, maybe a month or two ago events. And then the other thing that is super fascinating about it is the unprecedented access that Walter Isaacson had to Elon Musk. He had similar access to Steve Jobs, not as 24/7 as he did to Elon. And the Elon one is just brutal. Like there's so much stuff that he talks about, like how even his brother sometimes thinks he's like a fucking idiot.
Why do you think Elon allowed the autobiography to be written?
I think he has this extreme sense of right, which basically includes, hey, let's, I could see him thinking in the way of hey, if an unbiased person comes in and observes me for a couple of years, whatever they write is open game. Right. And it's okay if it's negative towards me.
Right.
Because there's also plenty of positives too. I mean, Isaacson recognizes his genius as well, but there's a lot of stuff.
Yeah. It's not like a puff piece by any means.
No, have you read it yet?
I haven't. I heard the interview with Lex Friedman though.
Oh yeah.
I read the Steve Jobs one. I decided I need to listen to that because his books have really long chapters.
Yeah.
And
the Steve Jobs one is also excellent. I loved it.
It is. The chapters are just so long. I'm so ADD. I need an end point to take a break, and it's just kind of hard to do when there's really long chapters.
And all the sort of insights between the different characters, the Bill, in the Steve Jobs one, Bill Gates and Steve Jobs, and their whole sort of. There's so much interesting stuff in there that is super fascinating.
Nice. I mean, it was great having you.
Thank you. It was great chatting about this stuff. This is my jam, right?
Are you excitable?
Well, I
feel like you're a little excited right now.
I get excited when I talk about, Starship maybe.
Yeah.
Because now I'm imagining myself in that freaking,
You're not going to go in the Virgin Galactic one?
It's suborbital. What's the point?
Like the plane?
Literally you can take a flight that would be similar to that today for $8,000 on zero gravity, and they'll take you, instead of once, they'll take you 8 times up and down, and you'll have zero gravity for 45 seconds at a time for 8 times. I'm actually I need to pull the trigger and do that, by the way. Whereas you are
going to do it
for not the Virgin Galactic, the zero gravity. And you can do that for, what I'm saying is it's similar to that in the experience of weightlessness.
And it's not $250,000.
Exactly.
Right.
Not to mention, they're not even doing it. I think when was the last time they launched someone?
I don't know. I thought they went bankrupt.
They might, if not, they're probably on the verge of.
Yeah.
That may have been a Chamath.
That was a thing. Yeah.
Grab, right?
Yeah. That was a pump and dumper.
What a piece of work.
Yeah. There's. I get it, right? I would say who doesn't pump their own book? You know what I mean? That is a fact. I don't think he got into these things knowing that he was going to dump them.
Well,
do you think? I mean,
he certainly set the expectation that he wasn't going to.
Sure.
You know, and when he was dumping things, he was still giving interviews in very positive light, as if he is holding on to things. So, I mean, he definitely misled quite a bit.
100%. But like, if he had Savvy Trader, this wouldn't be an issue because people would know automatically when he got out, right? This is the problem you're trying to solve, is so people know when to get out.
Right.
Back to Savvy Trader. This episode is brought to you by Savvy Trader. What I do like about Chamath, right, because he is like very grandiose and narcissistic, but he knows it, right? And I think it's a character he plays, right? You know, but he does get he's
a smart guy.
He admits when he's wrong.
Sometimes.
Yeah, you know, sometimes.
Sometimes he takes both sides of the same issue at different times, and then
depends who he's talking
congratulates himself on being right. Wait, did you forget you also said this?
Dude, predictions are like a big thing in investor land, right? I mean, people love calling their shot,
right?
And recognizing that's all in now is all in all the time is. I called that back in this episode. Let's replay it.
Right.
Like that, they put so much weight into them calling their shot.
They also have been wrong so many times. They never talk about
about that.
I mean, basically everyone, including all of them, predicted a major economic major recession, right? Mm-hmm. For the past 2 years. Mm-hmm. I mean, including myself, by the way. But you know, they never bring up that they were wrong about that. Right?
Well, it hasn't happened yet. It's like throwing a rock in the air and saying recession is going to happen. You know, it's going to fall eventually. You just don't know when.
But in last year, maybe even late 2021, they were calling it that it was going to happen in early 2022. Mm-hmm. Then early 2022 was like, it's definitely happening by Q3, Q4, right? Like it was just always sort of like 2 quarters away. And that theme was pretty consistent for a long time, including on their podcast. But yeah,
no, I think so. They didn't take back about remember they thought there was going to be like this global famine. You know, no one talks about that. You know, that Europe is going to freeze over, is going to be like, you know, the apocalypse.
Right.
And, you know,
100 million people, I think, is
without food. Yeah.
We're going to die as a result.
Yeah. That
was the estimate.
Yeah. That just didn't happen.
By David
Friedberg.
I actually like him.
I think he's the most human out of that group. Yeah. What is your, what's your thought on the economy? Do you think soft landing, hard landing?
You know, it's hard to say. Like for me, it's hard to predict the macro stuff. And I try not to do too much of it. But I think Q3 numbers are going to be great across the board for most of the companies. But you know, with interest rates being as high as they are, it's hard to imagine something not breaking at some point, right? Like you know, I think 7.5-8% interest rates for homes is weird to have without home prices having collapsed.
Correct.
And both of those two things are true, meaning home prices have not collapsed and interest rates have tripled in the past year.
Well, it's because everyone refied when rates were 0, right?
So they're not selling their homes.
So I would say the volume's gone down, but everyone's hanging on to their home. So the prices aren't going to go down.
Right. But so the hanging on to their home is can only last for so long, right? So because if you have to move,
and there's low inventory, so when stuff does happen, the prices are higher.
Right. So that's what's kept things in balance to some extent. But at some point, the normal equilibrium of sellers and buyers have to happen.
Right.
You know what I mean? And when that happens, I think prices of homes will probably go down. It's hard to say.
Yeah. Ray Dalio, thumbs up or thumbs down?
I like him.
World's going to end?
Well, he doesn't exactly predict when, right?
Right. Right.
But the collapse of empires, his arguments for it are hard to argue against.
Totally.
And there's a lot of sort of signs of those things. The $30 trillion in debt that the U.S. has is not a good thing.
No, you can't explain that away.
Yeah. I mean, it's basically like it's money we're basically never going to pay off, right? Like it's near impossible without major inflation happening. So something's got to give.
Or a restructuring, right? But what does that do? I don't know.
What restructuring? How?
You just make the bonds longer, right? Can you do that?
Well, you got to bring the interest rates down first,
right,
to zero again, and then refinance the whole thing based on a 500-year loan.
Yeah. Stranger things have happened. I mean,
and then balance the budget so that you don't continue to add to the debt. So,
it'll happen. You just knock the can down the road.
Like I said, it's got to break first before you fix it.
Exactly. Everybody, thank you so much for listening to another episode of The Capital Stack. If you liked it, please subscribe, tell a friend, rate a review. It helps us out. And we drop an episode every week. Go to the new, fresh davidpaul.com. It's really a big deal. A lot of people have been requesting to personalize the domain. I had to buy for like $1 million. And yeah, just kidding. But you'll see a blog there, my blog, as well as all the podcasts and stuff about DWP Capital, where we invest in early stage startups. So have a great week, and we'll see you next week. Thank you. Bye-bye.
Thank you for tuning in to the Capital Stack Podcast. Make sure to share this with someone you know that can benefit from this content. Remember to support this show by rating, reviewing, and subscribing. David Paul is the founder and general partner at DWP Capital. All opinions expressed by David and podcast guests are solely their own opinions and do not reflect the opinion of DWP Capital. This podcast is for informational purposes only and should not be relied upon for decisions. David and guests may maintain positions in the securities discussed on this podcast.